Hi guys, welcome. Have you been in the situation where the stock price stays flat or worse, tanks right after a strong earnings report? There are many reasons why this happens, and in this video, I'm going to use Qualcomm's financial reports as a case study to answer this question. So, let's jump into it. Qualcomm has just released its latest quarterly reports for Q2 of 2021. Revenue is up 52% year on year, and net income and earnings per share are up a whopping 276%. However, the stock price tanked from $145 to $133 following the earnings report. Here's the chart of quarterly revenue going back to Q4 of 2017. The revenue has jumped from an average of $5 billion in 2020 to the current $7.9 billion. And the year-on-year number is a high 52%. The reason is that it is based on the lows of 2020. In comparison, the quarter-on-quarter growth is on the way down. The projected outlook for the next quarter is between $7.1 to $7.9 billion. So on a best case scenario, the revenue of $7.9 billion would be the same as the most recent quarter. And if it comes at the lower end, it will continue on its downward quarterly path. The gross profit has been moving in tandem with the revenue and is on the way down. But that does not make Qualcomm a weak company. It is a solid 5G company evident by the high gross margins, averaging around 57% in recent times. The total operating expenses have also grown with the revenue. R&D accounts for $1.8 billion of operating expenses and not much change in selling, general and admin at $557 million. The R&D has been growing as technology companies need to continue with their R&D investment. After taking away the operating expenses, Qualcomm's operating income came at $2.1 billion. The net income is in line with the operating income and came in at $1.7 billion. The net income is on the way down too. The year-over-year gain of 276% is again huge as the base used is the low net income of $468 million achieved in the previous Q2 of 2020. The gain in absolute terms is $1.3 billion. Since the high end of projected revenue for the next quarter is the same as this quarter, we can assume that the best case net income will maintain the same level at $1.76 billion. But since the base comparison will be the Q3 number of 2020, the difference would drop from 276% to 108%. These are probably the reasons why the stock tanked right after the earnings report. The market has been anticipating a solid quarter-over-quarter growth, but clearly Qualcomm is declining. Although the net income is on a decline, it is still a decent 22%. The earnings per share is declining and is at 153 currently. Let's take a look at the cash flow report starting with the operating activities. Looking at the report, I did not see any outstanding items to highlight. Looking at the trend, it is clear that Qualcomm has moved higher up in its cash flow position and is producing positive cash flow from operations consistently. The investing cash flow is normal. There is a constant cash outflow in investing activities. It is primarily due to the investment in debt securities and capital expenditures in property, plant, and equipment. The free cash flow is also increasing. Free cash flow is operating income minus the investment in property, plants, and equipment. It is an indication of the real earned income after investing in continued operations in the business. Qualcomm has a good stock repurchase plan, and they also pay dividends, which is another plus. But as you can see, they are not paying back their debt. I would really like to see them reduce their debt. Although the free cash flow is growing, the overall cash position is growing weaker due to stock repurchase and dividend payment. Not a very good sign. If this goes on, I think Qualcomm's debt will only increase. Even though the revenue and net incomes are growing, the overall health of the company is not strengthening, and the quick ratio is getting worse and is sitting at 0.6. Qualcomm's total assets are $37 billion and the total liabilities are $30 billion. There is not much to highlight in Qualcomm's assets. Qualcomm currently has a debt of around $15 billion, which is 41% of total assets, and the debt level has remained flat. Qualcomm should use its income to reduce the debt level. The net interest over net income chart is one of my favorite charts. The gray area plots the net income, and the blue represents the amount spent in paying interest on the debt. As the quarter-over-quarter net income is going down, the interest expenses as a percentage of income is slowly creeping up from 6% to 8%. The book value per share has been rising and is at $6.50 currently. The book value measures the net asset value, that is, total assets minus the total liabilities on a per share basis. At the current price of 137, Qualcomm is trading at a multiple of 18.4 times price to book. That is a very high valuation. Usually, value investors look for a multiple of below 5. Due to the high year-over-year revenue growth, the PE to growth ratio is a low 0.38, indicating that the share price has not appreciated at the same rate as the growth in year-over-year revenue. A value below 1 and above 0 is a value buy. But as we know, the quarter-over-quarter revenue is on the way down, and so the PEG ratio needs to be discounted. Now let's take a look at the charts. The markets sold off heavily after the earnings report the previous quarter. It gapped down with a high volume, and the recent rise was not able to come anywhere near those levels. While Qualcomm dropped after the earnings report of the most recent quarter, the drop was not as heavy as the previous one. The volume was smaller, but there were still gaps. It is an indication of more likely selling in the coming days or weeks. There is strong overhead resistance at 142 region and immediate support at 122. So is Qualcomm worth investing in? It is a profitable technology stock, but the revenue and net income are on the way down in recent times, and their substantial debt is a big concern for me. It does not look like it has much growth potential. Is it worth it at current prices? The valuation of 18.4 price to book is way too high, but the PE ratio is decent at 19. Technically, I'm bearish on Qualcomm and I'm expecting it to drop further. For these reasons, I would not invest in Qualcomm. Coming up next is Skyworks Solutions. That is a solid 5G company. And I will be performing a side-by-side comparison of Qualcomm and Skyworks Solutions similar to the one I did for the AMD versus Intel. Subscribe to my channel if you have found this sharing useful and hit that notification bell so that you don't miss out on any of my future videos. And I'll see you soon in the Qualcomm versus Skyworks Solutions video.